Hi, in this video we'll talk about how to account for income taxes. Okay, here's an outline, and I won't be able to cover all this in the first video, but we'll cover all of it eventually. So big picture, guys, what we're talking about is not the Internal Revenue Code. We're not going to get very detailed on that. There's a whole other class for that. What we're concerned with here is from a financial accounting perspective. Under US GAAP, how do you account for your income taxes? They say a picture is worth 1,000 words. Sometimes I think equations are also worth 1,000 words. So here's kind of a picture with a few equations on it, which really is the key to the whole thing. Here's the deal. The IRS has their own rules. They are a modified cash-based system. So they have some accrual components, but largely it's cash-based, right? So from the IRS perspective, you know, any money you receive in your business, they consider that taxable income. That's taxable revenue. Whereas from US GAAP standpoint, we're accrual-based. So just the act of receiving money is not enough to say that that's taxable income. Not taxable income, to say that that's earned income. To recognize revenue under US GAAP, it must be earned. So even if people paid you on credit, you didn't actually get any money, you oftentimes can have high revenue under US GAAP. So, okay, US GAAP, our pre-tax financial income, is not the same thing as taxable income from the IRS. Okay, because we're based on GAAP here, and over here we're based on the tax code. So because of that, you know, the income taxes you actually pay, the income taxes payable here, are never going to be equal to your income tax expense that you record on your financial statements. That income tax expense is an accrual-based thing. It's just a certain percentage of your pre-tax financial income. Okay, so very big difference here. So if I want to know the actual amount of money, taxes that I owe, I take my taxable income, which is the amount I owe, or the amount of income I have according to the IRS, and multiply that by the tax rate, and that is the amount I have to pay. That is not going to be the same number as the income tax expense, and you can see why with the formula, right? For the income tax expense, I take pre-tax income under US GAAP and multiply that by the tax rate. So the two are very rarely equal. Why are they not equal? Well, the major reason is temporary differences. There are some permanent differences, but the major reason is temporary differences. And so by temporary, I mean sometimes you have revenues or gains which are not taxable until later. What are some obvious examples? Credit sales. Okay, you just sell things on credit, you get accounts receivable. That increases your pre-tax income, right? Under US GAAP. That does not increase your taxable income. The IRS says, oh, people owe you more money. I don't care. IRS is largely cash-based. Remember that. Similarly, you could have an unrealized holding gain on a debt or equity security that you own. Again, it's unrealized. You haven't realized it. You haven't sold it. So that's not taxable from the IRS perspective. So both of these situations, realize that it's just a temporary difference. Okay, so you're getting some income now under GAAP. You're not getting it under the IRS. But later on, it's going to be the opposite. It's going to reverse, right? If I sell on credit today, I get pre-tax income. I don't have taxable income. But then next year, when I actually collect the money, under US GAAP, I don't have income. But under IRS, I do, right? Because I collected money. It just reverses the next year. That's why they're called temporary differences. And there's a few others. You can read about that. You could have the other way around, where you have a revenue or a gain that's taxable right now, but it's not recognized under GAAP income yet. And so that's kind of the opposite, right? You have cash received in advance of doing a performance obligation, aka unearned revenue. So under the IRS, under their tax code, say, yeah, you receive money, that's taxable. Under US GAAP, it's like, no, I don't have any income. All right. You can see some other examples there as well. You can also have expenses that are deductible for tax purposes faster than they're recognized as expenses under GAAP. Most common example is depreciation. So under the Internal Revenue Code, they use the Modified Accelerated Cost Recovery System, also known as MACRS. Okay, MACRS depreciation is rather accelerated, and so you're going to be able to deduct large depreciation expenses that are larger than what they would be under GAAP if you use, say, straight line depreciation. All right. Of course, that'll reverse in later years, right? For whatever tangible asset it is, there's only so much book value to depreciate. So over time, the accelerated depreciation number will become less than the straight line eventually. It's got to even out, right? Oh, you also have prepaid expenses. So if you prepay an expense, you are putting money out. You're out cash. You can deduct that from your business under the IRS tax code. Of course, we know under US GAAP, you don't get to subtract an expense just for prepaying it. You know, expenses are accrued when they're incurred. We also have accrued expenses that are recognized. This is the other way around, basically. Recognized in book income, but not tax purposes until you actually pay cash. So things like bad debt expense, all those accruals, warranty costs, expected litigation costs, things like that. You know how we expense stock options even though you haven't actually paid the executives anything yet? Those are all accrual expenses, and we get to deduct those from our revenues when we report, to arrive at pre-tax book income, US GAAP income. Obviously, we would not get to deduct those from our revenues for tax purposes, because we didn't pay any cash yet. Okay, so I think that video, that's enough for now. That pretty well covers the concepts.